Dividends investing is seen as the true passive income source. So this is one of the few things where you genuinely don't have to do much once you've actually put the money into the dividends paying stocks or ETFs. So it's one of the most popular ways that people invest in order to generate regular income. So in this video, I'm going to break down how to invest for income using stocks and ETFs. And we're not going to go into real estate or things like crypto or anything else. We're just going to focus exclusively on dividend paying stocks and dividend paying ETFs. This is Roadman Investor. Make sure you subscribe, make sure you like, leave your comments below, share, and click on that notification bell. Very important, so you don't miss anything that we upload. Now, so first thing you need to know is that all companies are not created equal and all ETFs are not created equal. So depending on where you are in life and what your actual achievements are in terms of, have you built the wealth and you want to preserve it, or have you accumulating, you'll have different strategies. So dividends investing tends to appeal to people who already have, a goal of creating regular income, usually for either retirement or people who want to retire early or people who want to supplement their existing income. Now, if you're a young person, say you're in your 20s, income generation might be secondary to you. You might want to focus more on accumulating very quickly. So this is for people who either want to build long-term consistent income, or people who want to use this as a supplement, or people who are nearing retirement or in retirement and just want something that's going to go on. So why would a company pay dividends? So a dividend is a payment from a company for investors as a thank you for investing in them, and also to kind of share some of the money they've made, some of the profits that they've made. So you'll have a company like, say, Coca-Cola, massive company, global presence. They're now in a position where there isn't a lot of growth to be made. There isn't a lot of reinvestment required. So they say, what do we do with this money? I know, we'll reward our shareholders. We'll give them a piece of the pie. So this will encourage people to remain invested in Coca-Cola. It also means that people will tend to invest more in Coca-Cola, and they'll have the peace of mind of knowing that, without having to sell their assets, i.e. the stocks, they can gain income from the assets. So that's why companies primarily pay assets. Now, what you don't want to fall for are companies that pay ridiculously high dividends to lure you in. So when you see something with 30, 40, 50% dividend yield, you want to be careful because a lot of time they're there trying to get you in to invest in this company that's not necessarily performing well, and then that'll mean that you're now stuck with a company that's your share price is going down and you're losing money effectively, and you don't want to sell because you don't want to lose, you want to take that loss on your income. So talking about dividend yield, what is the dividend yield? So the dividend yield is the percentage of what you've invested in the company or the stock that will be paid back to you as dividends. It's usually in the form of a percentage. So if we have a look here, I'm just going to show you my trading 212 screen. So if you just typed in, I don't know, Coca-Cola, because that's one we've just used as an example. If you just click on that, you scroll down the page a bit, and then you see where it tells you the dividend yield. So over here it says 2.88%. What does that actually mean? It means that for every £100 that you have invested in Coca-Cola, you get £2.88 per year. So remember, this is not per month, this is not by quarter, this is per year. So if you want to work out what it will be per month, it's 2.88 divided by 12. So it's around 0.24% per month. Now, I know that Coca-Cola pay their dividends quarterly, so a better calculation will be quarterly, how much you likely to get quarterly from Coca-Cola. So you want to do 2.88 divided by 4 because there's 4 quarters in a year, and that will give you 0.72%, which means that if you wanted to work out what you're going to get, say you had £10,000, so you got 0.72 per quarter, you divide that by 100, because don't forget that's percent, okay, and then say you have 10,000 in there, £10,000, and then it means you can expect to get around £72 per quarter from Coca-Cola if you have £10,000 invested. So that's an easy way of working out what your dividend yield will give you per year, per quarter, sorry, in this case. Obviously per year you just multiply that by 4. So if you want to then figure out how much do I need to retire, let's say, you need to work out what your retirement number will be. So how much money do you want to live off in order to work out how much dividends you're going to need to get that. So for example, this is in the UK we have something called the Stocks and Shares ISA. So any ISA will protect your money from tax from the government. So in the Stocks and Shares ISA you can buy shares and stocks and other asset classes, and anything you earn from them will be completely tax free. The US have other different types, so they got the Roth IRA and so on. Canada will have theirs, Australia, all these different countries. So depending where you are in the country, where you are in the world, make sure you try to take advantage of any of the tax-free or tax-efficient packages that are available to you, because last thing you want to do is make money only to give a big chunk of it to the government. So assuming there isn't going to be any tax on this, say for example you want to make £36,000 a year, which £36,000 per year, which means that per month you're coming out with around £3,000. If you want to work out what you need to have in the bank in order to get that amount of money from Coca-Cola, using this example, so what you want to do is to say again 2.88 divided by 100, so that's the percent, so that's 0.0288, and then you divide 36,000 by that number, so 36,000 divided by 0.0288, and that'll give you the amount you need. So you need 1.25 million invested in Coca-Cola in order to get £3,000 per year. Now, as you can see, that's a big number. So if you're reliant on just Coca-Cola, you need a lot of money. But some people will go this route because Coca-Cola is what you call a dividend aristocrat. It's one of those companies that have paid consistent dividends for the past 25 years plus, irrespective of any downturn in the market. So we had COVID, Coca-Cola did not care, they just kept paying it. So Coca-Cola is not the only one. There are other companies in the world that pay dividends, and if your focus is taking minimal risk and also you want that peace of mind, companies like Coca-Cola, Procter & Gamble and so on, those kind of dividend aristocrats are your friends. It means that you're able to have that peace of mind of knowing that your dividends are secure irrespective of what's going on. But as a result, they won't give you high dividend yields, unfortunately. So 2.88 is fairly low in the market, which means you need to have a lot of money. So if you wanted something that's going to require less amount of money in order to gain the same amount, so say for example we go into something like Rio Tinto, that we know is a higher yield paying company. So we look at the dividend yield on Rio Tinto, that's 6.63%. So sorry, this is like a lot of maths, but these are the kind of things that you need to understand if you're planning for retirement or you want something that's going to be consistent. So this is 6.63%, so you want to do 6.63%, so divided by 100. Okay, so that's 0.0663. So what you want to do then is to say, right, I want to make £36,000 in a year, and then you want to divide that by 0.0663, and you can see that this is 542,986. So you need substantially less with a Rio Tinto than you do with Coca-Cola, and it means that you don't have to have as much money invested, in Rio Tinto stocks as you would with Coca-Cola to get the same amount of money. But what you're trading with that is that peace of mind. At any given time, Rio Tinto can decide to cut their dividends or completely stop it. So they can say, right, we're not paying 6.63% anymore, we're going to go down to 5%. Or they can say, yeah, sorry, we're not paying any. And that'll be that. So yes, you need less money, but you want to not only get something that's high today, but you want something that would be growing gradually. Just a kind of warning in there. So in order to kind of guarantee that kind of income, you might want to not put all your eggs in Rio Tinto, for example. So just making that point there. But now you know how to work out what the dividend yield means for you, and also what money you need to have invested in a particular stock in order to be able to give you an idea of what you can get on a monthly, weekly, quarterly, whatever it is that your roles are. Now, the other way of doing it, because picking stocks is very difficult, because all stocks are not equal and no one can predict the performance of stocks. So what's really booming today could be bust tomorrow. So what you could do instead is go the ETF route. So an ETF is a bundle of assets. So if you want a dividend paying ETF, it will be fund manager, say for example Vanguard or iShares, who've put together all these different companies or different assets that pay dividends. So that means that you're not just relying on Rio Tinto or Coca-Cola to get your income. You want to spread that amongst different assets within that ETF. So what you can do, this is using my Trading 212 again. Once you click on the search button, so once you click on search, it gives you a different list of different categories on the side. So you can literally just scroll down and look at the different sectors there. Okay. So if you want something that's going to give you fixed income, you can click on that. That'll give you all the fixed incomes, such as bonds or the real estate ones, and so on and so forth. So we're interested in dividend paying stocks. So what you can do, dividend paying ETF. So you can just type in dividends up here, and then Trading 212 will give you a full list there. So you can see this is All World. This is the popular one from Vanguard. So this is a high yield world focused one. So this is a combination of all different companies around the world that pay high yield dividends. So you got global quality ones, you got UK focused dividends, you got US focused dividends, and so on and so forth there. So the question still is, well, which one do we go with? So I use my trusted Just ETF website. So if you go to justetf.com and then you just type in dividends, literally just type in dividends in there, and then you search. So you got 74 different options there. Now the good thing about this website is you're then able to sort using different criteria. So you can go with the daily charts, you can go by the names. So they have just sorted, it's gone from A to Z. So you got the Amundi first, because A comes before all the other letters. You can sort by the fund size, so that's got more money in than the rest of them. Or you can flip it the other way around. So this one's got literally no money in. I don't know why you want to invest in that. You can fund by total expense ratio. So this is how much the fund manager will charge you for managing the fund for you. So in this case, you might want to go lowest to highest. So the lowest one you can get is this one here, but bear in mind there's only £2 million in there, so might not be the best one. You might want to look at the performance, so what's performed the best over the past year. So it's this iShare Euro dividend one, and then you want to pay attention to either it's distributing or accumulating. Distributing means that the money will be paid into your actual trading platform accounts. So in my trading 212 account, I'll show you where it sits. So once you come out of this, so this is my Roadman Investor platform. It's just so I can play around and just use real examples. So in this case, you can see the value of that one, but you'll see here where it says cash. So this has got 96 pence paid in. So it just means that that money will sit there and you can then withdraw it if you want to. And that usually takes a day or two, and it will go into your normal bank account. If it's one that's accumulating, however, it means that the money will automatically be reinvested for you. You don't have a choice in the matter. So as soon as the dividends hit the bank account, into the investing account, sorry, they'll automatically buy more shares with it rather than paying out into your cash section there. It means that you don't get to decide when to pull it out, whether you want to invest in something else or whether you want to basically reinvest it. They take that option away from you. So once you've decided on which one you want to go for, so you want to look at the total expense ratio, 0.4%, and you've had 34% return, that might be acceptable to you. You don't want to see if it's full replication. Full replication means that they buy exactly what's in the portfolio. So for example, if you have a S&P 500 ETF, if it's a full replication, it means that that fund manager will buy all 500 stocks and hold them. And that means that once you buy that ETF, you're buying a piece of those 500 stocks as well. So that's full replication. There are other ways they do it. So they'll have like options, they'll have different accounting methods of doing it. So some of them might just use a sample size. It doesn't really matter to you ultimately, but you want to pay attention to those kind of things because that will have an impact on whether or not you actually own all the stocks in the ETFs, or maybe you just own a sample of them. So say for example, you're happy with this one, you're happy to pay 0.4% giving that return there versus 0.25% giving that return there. Let's go with that one. So you just go in there, you can scroll down and just have a little snapshot there. You can click on the chart, see the performance, so that's grown up nicely. You can see the ticker symbol. Click on the basics, it gives you a bit more information. So that's the index that is tracking. This is tracking the European stock market, so Euro stocks. So that's what it's focused on, the size of the fund, the expense ratio, so that's how much you're paying the fund manager to manage that. So that gives you all the things there. So the currency is in euros, it's unhedged, which means that there's an exposure if you're converting from your local currency, in my case pound sterling to euros, there'll be an exchange change there. So the volatility, how much it goes up and down when the money is paid out. So this one's paid quarterly, every 3 months, so you get 4 payments, and this is distributing, so this will actually be paid into your account. And where the fund is domiciled, so where's the headquarters of the fund, this in this case is in Ireland, and the fund manager, the fund provider, which is iShares. If you want to see what's in the fund, you click on the holdings, it gives you the top 10 straight away, and then you can look at the different countries, so Netherlands, Germany, France, what sector you got: financial, consumer, discretionary, utility, energy, and so on and so forth. So Just ETF is a very powerful tool to analyze the ETF, so you can see year-to-date performance, you can see in the last month, you can see since inception. This is a very, very high performing ETF. If you want to look at dividends, after all, that's what we're here for. You can see 2021 it was 4.15%, for 2022 4.41, 2023 5.58, so you've had that gradual increase. But then in 2025 it's gone from 5.82 in 2024 to 5.56. So you might want to think to yourself, why has that gone down slowly? Why has that dropped slightly when it's just been growing? So if it's just a 1 year thing, it might not be such a problem, but it's just another thing to bear in mind. You want to look at the risk profile, the volatility, that's just how much it goes up and down. And then you can look at all different things in there, and then the stock exchange that it's based on. So this is based in the London Stock Exchange. So if you looked at all that, you're thinking, yep, okay, I'm happy with that. That's the one I definitely want to go with. You look at the ticker symbol IDVY. You can then go into Trading 212 or whichever platform you're using and check if it's in your platform. So on this one, you got three options. So you got the Euro version, the Swiss franc version, and the UK version. So if you're based in the Eurozone and your local currency is euros, it would make sense to go with the European one, so you don't expose yourself to the foreign exchange risk there. If you're based in Switzerland, then obviously you might want to go for the francs, but we're based in the UK, so we're going to go with the UK version. Now, for some daft reason, the UK version is always in pennies rather than pounds. So 1,950 pence is not 1,950 pounds. It's actually 19 pounds and 50. So each one of this will cost you 19 pounds and 50. So what you want to do is make sure everything matches what you looked at. So 4.58% yield there. You want to look at dividends there, make sure it makes sense. So there is a bit of discrepancy. You want to look at things like that. So this is paid quarterly. You want to look at the 1 year performance. So just make sure it's the right fund for you. And all you want to do, okay, right, we're happy with this one. This one we want to go with. Click on buy, put how much you want to buy in there, send your order, and jobs are good done. That means that you know about your thing. So with this kind of thing, especially if it's income, you want to make sure it's in a tax efficient wrapper. So in this case, we've got the stocks and shares ISA in the UK, maybe your Roth IRA, wherever else you got, wherever you are in the world. You want to make sure that any excess income you have, say for example you're targeting £3,000 a month, and this thing is now spitting out, I don't know, 4,000. You might want to look into reinvesting some of that additional income, so it allows the compounding process to speed up a little bit. Also, you want to look at things like the distributing, make sure that it's got the tax implications. If you take the distribution in your local country, that might attract taxation. In the UK, because we've got the stocks and shares, I said that's not something that we need to worry about. So all in all, we've broken down what the dividends are. We've broken down the different kind of stocks that pay dividends. If you want something that's lower risk, then you want to look at maybe looking at dividend aristocrats. So companies that paid dividends over the past 25 years plus, and not only have they paid over the past 25 years, they've increased it gradually, but it means that they're not going to pay you high yield. If you want something a bit more high yield, then you need to have less money invested, and you'll get to where you're trying to get to quicker, but you're running a risk of potential dividend cuts or completely scrapping dividends. And if you're not quite happy to pour your money into individual stocks, then you want to look at ETFs, which are bundles of stocks that pay dividends. And within those bundles, the companies will pay the ETF manager the dividends. They'll then pay you as an investor some of the money they get from the dividends, and that's how you get income. It means you're not relying on individual stocks. It means that you're diversified because there's a number of different stocks within the ETFs, but you need to pay attention to things like the expense ratio, or the total expense ratio, which is how much the fund manager is charging you for managing those funds for you. You want to pay attention to the performance of the funds. You want to make sure that the dividend yield is in line with what you want. You want to make sure that you know if it's quarterly or monthly or semi-annually, so twice a year, or annually, so you only get one payment. It just allows you to plan. And if you have your retirement figure in mind, so you think, okay, I want £3,000 per month, £36,000 a year. I've shown you how to work out how much money you need in there, so you can just think to yourself, right, okay, I need £500,000, and then you can just go absolutely focused mode on hitting that target. So this video has kind of covered all these things. So I hope this video has been helpful. We've covered quite a lot. Sorry there was a lot of calculations in there, but these are the kind of things that you need to know before you start investing, because the worst thing you could possibly do is start throwing money into a dividend paying stock without knowing where you're going, and you just think, oh, I'm just going to put £5 in there and that's going to be enough. It probably won't. So you need to have that kind of strategy. You need to go into your mind going, right, I need £3,000, I need £4,000, I need £5,000 a month. You multiply that by 12, it means that, okay, I need to have X amount into this stock because the dividend yield is this percentage, and then I'm just going to get that kind of money. Or if you already have the money, so say for example you're nearing retirement or you're already in retirement and you have a big amount of money, it allows you to work backwards to know what you can expect, and you can use that to plan. So if you need to uh, £2,000 in income and you got £50,000, you can work backwards and know, okay, cool, this is how much I can expect back from this ETF or from this stock. So hope it's been useful. Make sure you share this one because this is a very, very important one. There are people out there who want to invest for income using dividends, but they don't quite understand some of these things. Help them out, share it with them. Also, make sure you like and subscribe. These are things that don't cost you anything, but it helps the channel massively. Click on the notification bell. That allows you to know every time we upload new videos, especially with this series where we're actually going hands-on. We're showing you everything. You don't want to miss this. Make sure you're there and leave your comments. Let's have a conversation. Let me know what I've missed out, some of the other tricks that you might have, some of the other calculations that might be helpful, and give examples of stocks or ETFs that you know pay really well. Obviously, we're here to help people to actually get more educated, more clued up, and more importantly, take control of their own financial future. It's been Roadman Investor. Join me next time.